I'll go ahead and start. So the welcome to this Financial Fridays with Sanies and Equitable. Today's topic is Investments 101, and Sanies is very excited to offer these sessions in cooperation with our corporate partner, Equitable Advisors. And before we begin, we'll hear a few words from our sponsor.
Support that's needed to make some of the biggest decisions in their life, like preparing for their retirement and their kids' college education. When an Equitable Advisor meets with a Sanies member, what our objective is to give them the confidence that they need going into retirement, making one of the biggest financial decisions they'll ever make in their life, to best assist them prepare with whatever their financial goals are. Equitable provides Sanies members includes financial resources and articles, complimentary financial profile meetings and an asset map, professional development educational webinars to units, and then in 2025 we're going to be doing a Ready to Retire series for people that are at least 1 to 3 years out from retirement and want to know how to finalize next steps. One of the benefits of being a Sanies member is on the first Friday of each month, we've always provided a Financial Friday series. It's a 30-minute series that goes from 12 to 12:30 that's presented by local regional representatives at Equitable that manage each region within Sanies on a variety of topics, including planning for the future, student loan forgiveness, and healthcare and retirement. What I would want Sanies members to know about the Equitable relationship is that you're going to have questions that come up, and there's always a tremendous amount of resources. There's an email address, saniesmembers@equitable.com, that can be utilized, and there's always somebody on the other end of that email address to address any questions, comments, or concerns. Best time to plan for retirement is today. Looking at the future immediately or as soon as you're able to, realistically, you're going to be best prepared for that future. Sometimes if people haven't looked for the financial future yet, minimally 7 to 10 years out from retirement, that threshold absolutely must start because you still have time to make effective change, tweaks, and adjustments to your financial situation to best be prepared. The most important message for Sanies members to know is that Equitable Advisors is there to help them as life comes up. It is normal and it's going to happen where there's questions, concerns, things you're unsure about, and you've got a tremendous amount of resources to help and support you through that.
Great. So joining us today from Equitable is Lucas Jankowski. Thanks for being here. And just a little reminder before we get going, the session is being recorded and we will save questions until the end of our presentation, but feel free to add questions in the chat at any time throughout the presentation. And our Q&A time is best used for general questions, but please know that the Equitable team is available at any time to answer your personal questions. You will find contact information for your regional reps at sanies.org. And now I'll turn it over to you, Luke.
Thank you. Hi, everyone. Lucas Jankowski. I'm a vice president here at Equitable, and I'm excited today. We're going to talk a little bit about investing. So, Peach, can you just confirm you can see my screen okay?
Yeah.
Awesome. So this is actually a topic we have not done before. I'm excited to do this topic for the first time. And just kind of an investment 101. This is not going to make you an expert in investments. You're not going to be ready to day trade on Wall Street with Warren Buffett, but it will give you a good foundation of how investing works within a retirement account. Just a quick disclosure slide. If everyone could take 10 seconds and just read over the disclosure for me, that would be perfect. Starting with a quick poll. So how would you rate your financial savviness when it comes to investments? Give it like 30 seconds or so.
Can everyone see the poll? I think we have 7 people who have answered the poll.
Okay, that'll be good enough.
Can you see the results?
I cannot, to be honest with you.
So it's 29% said A. No, nobody said B. 57% said C, and 14% said C, and 0% said D.
Okay, so it sounds like most of the group either has no clue what they're doing or they know enough to feel okay. All right, awesome. So when I talk about investments and going through an investment 101, oh, there we go. We're going to talk about 3 major asset classes and 2 sub-asset classes. When we think of investing, the first asset class that somebody can use is cash. Now, no one ever thinks of cash as an investment, but technically it is. And by definition, cash is any riskless investment. So checking savings, money markets, CDs. So you're not going to see your cash investments go up and down unless you take money out of your savings. But historically, they average a very low rate of return, about 0 to 3%. Now, we need cash investments. We need to pay bills and emergency reserves, and they're generally our most liquid investments. But historically speaking, cash does not keep pace with inflation. So we don't have too much money in cash because it's not going to beat out inflation over time. So in order to beat inflation, we have to take on a little bit of risk. And the first way we can do that is through bonds. Bonds are considered a conservative investment. They're not a riskless investment, but they are conservative. And what a bond effectively is an IOU from a company or government. So let me explain that a little bit. So if I'm the state of New York and I want to build a new thruway that's going to cost $1 million, I can either pay for that with cash or I could pay for that with bonds. So the state of New York may issue 1,000 bonds worth $1,000 each, totaling $1 million. If I, the investor, buy that bond from the state of New York, I am then lending them my $1,000. Now, you might be asking yourself, why in the world would I lend the state of New York $1,000? It's because they're going to pay me back with interest over time. And that's how I make money on the interest. So it's just like going to the bank and taking a loan out. How does the bank make money? They make money on your interest, but now you're the bank. So bonds can be issued by a variety of different organizations. So you can have US government bonds, you can have municipal bonds, which would be like town and state bonds. You can have corporate bonds, which would be large institutions, international, just any organization outside the United States, as well as high yield. And they can be issued in very short durations, 1, 2, 3, 4, 5 years, or 30 plus years. Just a fun fact for you, Disney actually has issued historically the longest term bonds. You can get a 100-year Disney bond. So historically speaking, bonds average a little bit higher return than cash, 3 to 7%. Now you're taking on some risk to get that return. What we find when people think investing is the stock market. Stocks go up and down every single Monday through Friday. Somebody investing in the stock market is going to take on the greatest amount of risk, but they're going to see the greatest amount of return over time, or so they should see the greatest amount of return over time. The way we think of the stock market is first by size of the company. So we have this large, medium, and small cap. Cap stands for capitalization. That's just the size of the company. A large cap company is going to be a company that's over $50 billion in value. These are going to be companies many folks are familiar with: Apple, Amazon, Google, Johnson & Johnson, Coca-Cola, Procter & Gamble. Your mid-sized companies are companies like Royal Caribbean, Delta Airlines, Dick's Sporting Goods. They're companies that are worth about 5 to 50 billion. So they're still very large companies. They're just not quite the size of our large cap companies. Small cap companies are companies worth about 500 million to 5 billion. So this would be like Harley Davidson, Papa John's, Corning Glass. They're all big companies. They're not local mom and pop shops, but obviously Harley's nowhere near the size of Apple. You don't see as many Harleys as you do iPhones. International companies are companies just domiciled outside the United States, companies like Nestle, Sony, Toyota. And then emerging markets would be investing in companies within growing economies around the world. Companies within countries like India and Brazil would really be the two fastest growing economies right now. We then have growth and value. So you can have large cap growth, you can have large cap value, so on and so forth. A growth company is a company that turns a profit every quarter or year and reinvest that profit within themselves so they continue to innovate, research, develop, and grow. So think Apple in this space. Apple turns a profit, they've reinvested in themselves so they can come up with new iPhones every year, new iPads, Macs, whatever it is, that have all new features. If you think of a value company, these companies are usually quite a bit older, 80 plus years old, and they're not really looking to grow in size. They've effectively said we're as efficient as we're ever going to be. This would be like Coca-Cola. Coca-Cola doesn't really innovate everything all too often, but people buy Coca-Cola, they turn a profit, and they want people to invest in their stock, so they pay dividends or cash to their investors. Typically speaking, your value companies are more kind of your steady eddies. Your growth companies are going to see more appreciation, but there's more ups and downs along the way. Now, there are two sub-asset classes, real estate and real assets. So real estate would be investing in what's called like a real estate investment trust. And then real assets are things like gold, silver, everything of that nature, commodities. They're not a huge part in retirement accounts, but they're absolutely real investments out there. The goal of investing is through proper diversification, we can take the mountains and peaks of the stock market and turn it into more of a rolling hills. So when it comes to investments within retirement accounts, something that's very important, a term many of you may have heard, is risk tolerance. What's your risk tolerance, or how much risk are you taking on? So there's conservative, there's moderate, there's aggressive, and there's places in between. That effectively means how much do I have in the stock market versus how much do I have in the bond and cash market. So if I'm an aggressive investor, I'm aggressive with my investments, I'm 90+% in the stock market. If I'm more of a moderate investor, I might be 60% in the stock market, 40% between bonds and cash. If I'm conservative, I may have very little in the stock market. Something that's really important is having the right risk tolerance for your financial situation, both with your comfort and what's going to be the best for your overall plan. Many folks think that if they're too risky or too aggressive for too long, it's going to topple their financial plan and their retirement. And that is a risk. But the much more common thing we see folks do is they not stay aggressive for too long, but they actually get too conservative way too quickly, especially as a New York State employee having a very large New York State pension. So it's just important to understand, A, what's your risk tolerance? B, is that where you should be, and is that appropriate for your overall situation? So how are investments handled within my 403(b)? When looking at investments, something that's critically important is there is always a relationship of risk versus return. When looking at investments, you don't just want to look at return, because if you only look at return, historically speaking, you might end up in investments that are way riskier than you want to be in. So there's what's called an efficiency frontier. And effectively what an efficiency frontier is or says is for a given level of risk, we should get a certain amount of return. So you can see in this graph here, the x-axis represents risk, the y-axis represents return. The farther right we are, the more return or risk we're taking on. The higher up we are, the more return we're getting. And this blue line represents the efficiency frontier. So to be fully efficient, we have to be on the blue line. And you can see this hypothetical portfolio, this red dot, is a moderately plus risk level, so 4 out of 5 in the risk scale, but is really only getting the return of a conservative plus investor. It's a problem. They're taking on too much risk for the amount of return they're getting. So we either need to keep the risk the same and increase the return, or keep the risk, decrease the risk and keep the return the same to get this portfolio to work fully efficiently. So it's something that's critically important is looking at, okay, how's my 403b or how's my whatever account doing? And is that what it should be doing, right? A lot of folks will say, my account's done really well over the last 10 years. And it's kind of like, yeah, pretty much every investment has done well over the last 10 years. Are you getting the most out of it? Are you getting everything out of it you should be getting out of it? So when looking at risk versus return, there's a couple important factors to look at. If you then take the holistic account and look at what's called the asset allocation. So that's just amongst those different areas of the stock, bond, and cash market where we invest in. So I have two hypothetical portfolios here. In an inefficient allocation, what you might see is people aren't just properly diversified. They're really heavily weighted in 1-2 areas, or they're really heavily weighted in not the right areas. So in an efficient allocation, we want to make sure we are A, taking advantage of all the right areas, and B, have the right weights or percentage in each one of those areas. Because in any given year, some areas of the market will do better than others. For this year, it looks like international large companies are going to do the best. Last year was US large companies. So in order to decrease risk and keep returns up, we want to make sure we're properly diversified amongst those different areas of the market. Additionally, one of the luxuries 403bs have over 401ks is, typically speaking, 403bs have a lot more investment options than a 401k. Most 401ks really only have 30 to 40 investment options. Most 403bs will have 80, 100, 150, not all of them, but typically speaking, they do. Just kind of food for thought. There are 800 companies in the United States that manage mutual funds, 800. And just like any other industry, they all have their little niche or areas that they focus on. So it's important to go out and make sure you're using the right mutual fund companies or money managers for each area of the market, or using what's best available within your accounts. To kind of give an example of that, you have like large cap growth. T. Rowe Price for 40 years was the best large cap growth money manager. It's a really competitive area for mutual funds. You have Vanguard, you have Fidelity, you have American Funds, T. Rowe Price, they all do a great job in that space. So then you get companies like a PIMCO that say, we don't really want to compete with all those big companies, but we still want to attract investors to buy our funds. So we're going to put all our research into bonds. And then you have companies like MFS that do a really good job in international funds, and a company like AllianceBernstein that does a really good job in small cap companies, whatever it may be. So it's just important when you look at that risk versus return, making sure amongst the different areas of the market, you're in the right spots and in the right amount in the right spots, but also using the mutual fund managers that do a good job in that space, really do the best job in that space. From there, it's important to understand that when you build and manage your 403bs, IRAs, whatever it might be, that building a portfolio has to be a living, breathing thing. Just like a retirement plan, just like a financial plan, it's going to change over the course of time. So you want to make sure you go through a proper review phase with that. Has your portfolio become less efficient over time? Maybe it's that there are other better ones available to us, or that our risk tolerance has changed, that some areas have become more weighted or more heavily weighted. So when you look at that risk versus return, thinking, okay, this year actually large cap growth, we should have a little bit more than large cap value or international, whatever it may be, or T. Rowe Price was the best money manager, but now Vanguard's really looking to do better, so we need to switch them out, or we're just getting closer to retirement and we need to scale back that risk over time. There's no way you can set up an account when you first start your career and have that be the most efficient account for a 30 to 40 year career. They have to be changed all the time. Things just change in the market, in the economy, and with these different mutual fund companies. So regularly updating it to make sure you stay on the most efficient path. How does the New York State pension work when it comes to investment allocation? So it's kind of a twofold answer. First is you have no control of how New York State invests those funds. One of the luxuries you have in your 403B is you can control how it's invested. With the pension, you cannot control that. That money does get invested though. New York State controls that, and about 70% of it is in stock, 30% of it is elsewhere. So it does get invested, but you can't go to New York State and say, I really want to change the investments. Unfortunately, they're going to kind of tell you to kick rocks. I'm going to transition a little bit from investments to types of accounts. So in the world of accounts, there are first what are called pre-tax investments. So in these type of accounts, money goes in and there's no taxes incurred to get a pre-tax deduction. Money then grows, and as the investments grow, you do not pay taxes. It's considered tax deferred. With your pre-tax 403Bs, you'll take the money out in retirement and you'll pay the taxes at whatever your income rate is that year in retirement. You also then have post-tax accounts, and those break down into different areas. So you have fully taxable accounts. These are non-retirement accounts. These type of accounts are funded with money that's already been taxed. You will pay taxes on any interest that accrue. And then as you take the money out, you'll pay taxes. So really depends on when exactly you sell the investment. But these types of accounts, you're paying taxes at all times. In a tax deferred account, this is a pretty rare and unique type of account. It really just applies to certain annuities. Monies in these accounts go in on an after-tax basis. They grow tax deferred, so you do get the benefit of growing without paying taxes. And then you take the money out and it is taxable. From there, you have what are called your tax exempt accounts. And this is where Roth accounts would come in. These type of accounts, money goes in on an after-tax basis. It grows tax deferred, so you don't pay any taxes as it grows. You take it out in retirement. It is tax-free. The New York State pension and Social Security are taxable in retirement. You will not pay state tax on either one of those, but you will pay federal tax on both of them. Social Security at a lesser extent than your pension. It's important to use pre-tax accounts to get the tax deduction, but at some point throughout your career, you really should have Roth or tax exempt accounts as well to not only diversify your investments in retirement, but to also make sure that you're diversifying your tax situation in retirement. Taxes will go up and down in retirement. You don't want the IRS to raise taxes 10% and you just lost 10% of your income because now they own a little bit more of it. So last poll that we have for today, how you feel in this moment about your financial plan in retirement? Give it one more minute. Paige, are you able to see how many people answered?
Yeah, so far we have 6 respondents,
Okay.
but yeah,
Um,
it ended.
yeah, we're good. Okay. So all but one said feeling okay. A little extra planning review couldn't hurt. I would agree. I would say a little extra review could never hurt. You're never going to lose anything. Um, so if you would like to schedule a time to review your financial plan, review your investments, review whatever it is pertaining to what we've talked about today, you can use this QR code. We'll send out an email after. And I know in the commercial it talked about the Saney's email. That's the Saney's email, and it'll send you to a complimentary financial profile and plan or investment review. And of course, part of that process is you get a complimentary asset map, kind of mapping out where everything stands, as well as just a trajectory of where you stand regarding your whatever your financial goals may be or retirement goals. Just want to save the last 2 minutes to see if anyone has any questions. PH, they can type the questions in the chat, correct? That's how that
Yeah,
works.
they should be able to take questions in the chat. There's a Q&A here too. Oh, nice presentation. Yeah, feel free to use the Q&A if you have any questions as well.
So someone said, are you affiliated with Equivest? Yes. So Equivest is one of the 403Bs that Equitable uses. So best way to buy bonds, what are the state bonds? State bonds are municipal bonds, and if you buy best way to buy bonds, that's a pretty wide range answer. I would really just say it depends on what somebody's goals are, what they're looking to accomplish with the bonds. State bonds do have certain tax advantages if they're bought within that state. But as far as the question, best way to buy bonds, I would really say it really depends on what somebody's goals are with the bonds. I am located in Rochester. The question is, are you located on Long Island? I'm located in Rochester. We do have Equitable representatives on Long Island, and then you can always reach out to the Saney's benefit email, and then we'll get you connected with somebody either in Long Island, myself, Kelly, whoever it may be.
Yes, yeah, you can find more information on your regional reps at saneys.org and hit the Equitable, the resources tab, and Equitable is on there, and you can find that email. All right, looks like that it's going to be all the questions.
Awesome. Thank you, everyone. I hope you have a wonderful Friday and a great weekend as well. I appreciate you taking the time to listen in today.
Yep. Thanks everyone for coming in for this webinar, and a recording will be available soon on our website and on our YouTube. All right. Have a nice weekend, everyone.
Bye, everyone.